The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Right, happy Friday, everybody. It's the start of the Olympics today. Can you believe that? Right, it is Friday. You're watching Scorebox, and these are your headlines. The S&P 500 and the Nasdaq on track for their second straight negative week as investors continue to rotate out of the major tech stocks. Well, US GDP, wasn't that a big number? Surprising to the upside in the second quarter, growing close to 3%. Business investment rising at its fastest pace in almost a year.
To the luxury stocks, here's another one. Hermes defying the slowdown in the luxury sector with sales at the Birkin handbag maker jumping 13% in the second quarter. And Excelola revenue rises 5% in the second quarter. That's despite slowing growth in North America, as the Ray-Ban maker confirms that tech giant Meta may take a stake in the company.
Beautiful live shot, Adam. Lovely there. How are you?
Good, thank you. Can't complain. You know, the Olympics actually started a little bit earlier. It's just the opening ceremony today.
Only the rubbish stuff started.
No, handball is great. The sevens rugby.
Do you know I've actually trained with the British women's handball team in 2012.
Really?
They sent all the anchors out to work with a different group of British athletes.
Okay.
And I got the British women's handball team.
How? I'm so interested. I have so many questions.
I guess the producer at the time thought that was kind of my forte.
Wow.
I was no worse at that than I'm at every other sport.
I've done netball.
Anyway,
wow.
I bet you have. I bet you've done netball as well, yeah. And tiddlywinks. Right, I'm amazed I got to air. Do you know, like 20 seconds before we got to air, it was only because of Hava Ali, who's our amazing tech ops, sound desk, floor manager lady that I even got to air.
Yeah.
Otherwise you'd be solo and I'll be going home. Right, back on track, which is the case on Scorebox, unlike Mercedes-Benz. How about this? This is horrible. This is a company that trades on 5 times forward. How many times have you out there been told, oh my goodness me, the auto sector is so cheap? Did you know that the auto sector trades on mid-single digit forward PE? The answer is yes, I did know and have known, unfortunately, for about a decade plus. And herein lies the problem. You may have lots of beautiful, shiny AMGs out there, but the profitability on these cars is staggeringly low for a lot of them. The top end, yes. But anyway, look, how about this? Mercedes-Benz, second quarter cars, adjusted EBIT down 27.5%, coming in at 2.76 billion euros. That is underwhelming. The car's revenue down 3.8 billion at 27.1 billion. Return on sales, this is the problem. The profitability of these autos has fallen to 10.2%, although that's better than many in the sector. I have to hasten to add this because they're at the luxury end. 10.2% versus 13.5% last year. So the turnaround is just not happening on the basis of this whole fleet of new electric vehicles. We saw what happened to Ford overnight as well. The Ford, dreadful performance in the last couple of sessions because of concerns that they're just not getting the profitability out of their current suite of cars. So return on sales at Mercedes-Benz falling aggressively. Group EBIT down 19.1%, but they have confirmed their outlook for the year. I'll just flip back to the shares. I don't know if Adam's got a quick board on those, but year to date, the shares, well, 0.66% higher, but down 12% over the last 12 months. So next time someone says to you, oh my goodness me, have you seen the cheap valuations in the auto sector? You need to look at the profitability of these companies and how tough the OEMs are finding the transition and the extra R&D that is coming as they change a lot of their suites to electric. Well, how about some better news? The US second quarter GDP absolutely knocked the ball out of the park yesterday. They grew 2.8% on the year. That is well ahead of the 2.1% that economists expected amid a boost. So two sides to this story. Now, this is interesting. A boost in consumer spending. That's not what we've been hearing from a lot of the retailers. That's not what we've been hearing from a lot of the banks who've been very concerned about the consumer side of events as well. So a boost in consumer spending was the evidence. It's not what we saw from the earlier home sales this week either, is it? And also, this is the other point, the fastest pace in business investment in almost a year. Wow. The core PCE price index, that actually rose 2.9%. That is ahead of estimates, but well down on the 3.7% reading in the first quarter. The main PCE reading is due later today. Arabile has hot-footed it like an Olympic athlete, like an Olympic netball superstar to the wall.
Hopefully no foot fouls on that one. But the question mark is, what does that GDP number then do when it comes to those expected rate cuts? Is September still in play? Has that knocked it down perhaps to December? Is July still the question mark that everybody's asking themselves? Maybe they should actually be cutting in July instead. That's a question mark. That's something we'll then ask some of the analysts who join us then across the show as well today, amidst all the earnings as well that we have to certainly get through. Yesterday's market picture stateside then was pretty mixed following on from that GDP print. There is still this pull out then from a lot of those mega tech players, and in fact across the week, in fact, that's what you've seen. And so you're seeing that now, but the Dow Jones Industrial Average then perhaps backing the trend a little bit, 0.2% higher. But this is the interesting board then to kind of show you that sentiment around the rotation that is really happening in this market. For around 6 of the last 7 days, you've seen a drag down for both the S&P 500 and the NASDAQ. So both of those have gone into negative territory, and it's showing itself thus far, just for this week, 2% down, 3% lower than for the NASDAQ as well. So it tells you that those tech players perhaps getting a little bit drawn out of them. But the question mark is where they're going to. Well, here it is, Russell 2000. The Russell 2000 index is actually up for a third positive session yesterday in the last 4. That index is up 1.8% for the week. Again, outperforming some of the major markets as well stateside. Those big tech players that we've been speaking about, this is what they look like then. We had seen a whole lot of red this week for all of these players, and that continues even yesterday. Tesla, the only one perhaps trying to rebound following on from what you saw the day before, of course, having seen that 12% decline then for Tesla. That's trying to drive that a little bit further back now, but only 2% higher considering where that loss was. AMD down more than 4%. For the week then, you're also seeing significant losses, more than 4% lost across Microsoft, Meta, Tesla, Nvidia, and Alphabet as well. So negativity certainly in that tech space as that rotation continues. Here's your treasuries picture then as well. The 2-year yields easing slightly then this morning, a level last seen, in fact, in early February. So 4.43 is where you're seeing that. 4.24 then as well for that 10-year note. Just the yield curve as well, just to note on that one. We're now sitting at 19 basis points. Interestingly, that is steepening. We'll get a sense of why exactly that is moving along as well, in spite, of course, all of that GDP data we got yesterday. Let's move on to Asia very quickly then here. Asian stocks rebounding after what we saw was a sell-off in previous sessions. But that rebound has now fallen off then. You're seeing a pretty much flat stance with a negative tilt. In fact, below 17,000 points for the Hang Seng thus far. The Shanghai Composite down 0.2% just in terms of companies. Chipmaker Renesas is down for a second straight day, having plunged 8%. Then so far today, there was a significant drawdown the day before. That net profit figure for the first half of the year is down 29%. So that certainly hurt. The automakers are also down, Nissan down 4% as well. And you're seeing even Honda saying that they're set to shut a factory in China then and halting production there. So very interesting news coming out of Asia, Steve.
Super duper. And I hasten to remind any of you who are fully invested as investors rather than trying to day trade or short-term tactically trade this, you've had a fabulous return out of the NASDAQ this year as well. You have had a fabulous 14.5% increase in the value of your underlying asset, plus any dividend, of course, which I'm sure you're going to reinvest as well. So I don't feel too sorry for you. Right, in the meantime, EssilorLuxottica confirmed its long-term outlook for after posting revenue. A jump of 5.2% in the second quarter, despite lower growth in North America. The luxury eyewear maker's CEO also confirmed reports that Meta is considering a stake in the company. How fascinating. The comparison of the jump over is pretty obvious, isn't it? A stake in the company, saying he would welcome such a step. Meanwhile, I'll tell you what, the team were all ready to talk about I don't know, problems in the basket and the bags and what have you, and now it's a mixed bag. I like that one. I think that was Amelia. Hermes Birkin bag, a mixed Birkin bag in the luxury sector, because Hermes also beat analyst expectations to post a 13% rise in revenue in the second quarter, defying concerns in the sector after disappointing earnings from just about everyone, including the giants LVMH and Kering. All regions except for China grew by double digits. But the executive chairman, Axel Dumas, thank you, warned that the number of aspirational customers has fallen. I bet it hasn't. I'm sure they're all aspirational. They just can't afford it. Amazing. Absolutely amazing. We've talked about the exceptionalism of Ferrari, because you like driving around a Ferrari. And we talk about the exceptionalism of Hermes, because they are absolutely the tippity top of their sectors as well. Tell us all about it.
Well, I guess when you cater to wealthier buyer, you're less impacted by the economic slowdown. That's what we see here, as you were saying, with Ferrari. We saw that with Moncler to a certain extent. We saw it with Brunello Cucinelli as well. And finally, now with Hermes, those numbers, we know that they are in the league of their own. The business model themselves, they sell less than there is demand out there. They just keep opening workshops because there's so much demand. They have 23 workshops at the moment to make their bags, for example, and they just need to open more to actually cater to the demand. So that's how they're keeping the exclusivity, and this is working, as you were saying, all regions growing double digits except from China, but there's still also growth in Asia Pacific, excluding Japan. It was up 5.5%. Interesting to comment on the aspirational buyer, because it's often thought that the first step to Hermes, or maybe the only accessible step to Hermes for the aspirational buyer, is silk. Is the scarves or the ties, and that's one of the divisions that actually traded lower, down 5.6%. Really? So it shows that the aspirational buyer is really squeezed and they cannot access some of these products. So that's very interesting. But leather goods up 18% in the second quarter, ready to wear at 15%. So here again, we see that in a league of their own with Hermes. The trend, they had actually an acceleration in Americas as well. So that was an interesting one to watch, up 13%, Europe up 18%. So across the board here, some positive results from Hermes, and they say they see no big interruption in the trends in the first months of the summer as well. So here again, an interesting one to watch, and we see really how luxury is being divided between different players. The ones that are being really impacted by the squeeze of the aspirational buyer. We talked about Gucci yesterday, we've talked about Burberry a few days ago. You have the middle ground, it's a bit like LVMH, that are slowing down. There's still a little bit of growth, not the boom that we saw after the pandemic, but still a bit of growth. And then the top of the basket, the ones that caters to the wealthiest buyers, and they are just not impacted at all.
Wow.
So some of the watches. Sorry, I just made note because
go on.
revenue for watches then dipped what was that, 5% or so then. So that I'm hoping, I'm a watch aficionado, surprisingly actually.
Right.
And I was hoping then that means prices will drop off. But when you start to still look at the prices of some of the watches that Hermes makes.
Are you going to buy a Hermes watch? They're not a classic. I mean,
no.
They're not like, with respect, they're not Swiss watches, are they?
So,
but this is a very good point, actually, that historically there were only about 5 or 6 brands that were worth buying if you were a collector of watches. Hermes are beautiful timepieces. In fact, I know someone who has a couple of them, but they're not classic. They're not like a Vacheron Constantin or a Patek Philippe, are they?
No, and that's
they have also tied up with Apple, which is quite interesting. They were one of those brands that had the collaboration with Apple for the Apple Watch.
Strap? Yeah. But I mean, funny enough, I was having a little peruse as well, and Sac à Dépêche, messenger bag, £6,490 on the website as well.
And as we were talking with Ferrari as well, the secondary market. As we know, they are a good investment. The price doesn't go down, the value doesn't go down when resell.
This is, going back to his watch
for
comment,
the Birkin bags.
I think the top end of watches, art, wine, bags, automobiles, all of that is still there. But there is a lot of product out there, whether it's cars, watches, bags, you name it. Whereas actually people have said these are vintage or luxury. Or the marks you need to own, but actually they're not. And a lot of people sold vehicles and some things that, these have a brilliant second-hand mark. They don't, and I think that's being extremely badly exposed now as well. I know the watch market, it has dropped out a lot of it. The automobile market has dropped out, but for the top-end Ferrari or the top-end Birkin bag or the top-end Patek Philippe, it is still there. It's extraordinary.
And all this, the differentiation between the different luxury players is so reflected in their share price.
So reflected,
It really is like the Hermès is the only one that is up over the past 12 months when you compare to LVMH, to Richemont, to all the players. This one is up. Hermès is up over the past 12 months. All the other ones are down. So it's really starting to play out.
I'm just going to have a quick look again at here you go. The price earnings is 42 times on Hermès. But the thing about Kering is the Pinot family, isn't it?
Yes.
Hermès, obviously they're Hermès families, but they still got very tight ownership, both of these groups, haven't they?
LVMH as well. A lot
LVMH
of
as well,
these
yeah.
luxury players
with
are
the
very
Arnaults,
controlled by the family. So
it's extraordinary.
Yeah.
Great. Okay, that's fantastic. I was going to do some Hermès tie anecdotes, but I won't bother as well. The prices are quite extraordinary, aren't they?
And that's the aspirational buyer. It's reflected here. You know, it's the traditional present that you would get a scarf to someone for a special birthday, and they're getting more and more expensive as well.
To the one time I was visiting. I had to go to France, and a friend of mine said, "Oh, would you please go and get me a Hermès scarf?"
Nope.
I just thought, how much do you think I earn? Because it's supposed to be the traditional gift.
We
but
better
as you
take
said,
a break. I agree that the
aspirational
price has
buyer.
been crazy. My first Hermès tie I bought in 1989 for £60.
You can add a zero now.
No, I got rid of I got rid of all my 80s ones. They were appalling because they were quite garish. And I could send them all down the charity shop. That was stupid, wasn't it? Thank you very much indeed for that. And LVMH is lacing up its trainers as a sponsor of the Paris Olympics. We'll be joined by CEO Bernard Arnault in an exclusive interview at 1200 CET. Coming up on the show, Arabile.
Euronext posting a jump in quarterly net income as it cheers lower than expected costs of integrating the Milan exchange into its network. Would break down the numbers with the CEO, Stéphane Boujna. That's at 8:20 CET. Later, Alphabet shares still falling then, particularly in extended trade after OpenAI announces the prototype of Search GPT. Which is an AI search engine, it says, will allow users to search online in a more intuitive way. And we'll also be speaking then to the CFO of German defense group Hensoldt, just days after the UK and Germany sign a new pact and look to ensure the continued supply of arms to Ukraine. That's coming up this hour at 7:45 CET.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Right, Signify has posted a second quarter adjusted net profit of 118 million euros, coming in below expectations. The group is maintaining its full year guidance, but it says it remains cautious on China and Europe going into the second half of the year. Always a pleasure speaking to Eric Wonderlat, who is the CEO of Signify and joins us now. Eric, after the April announcement, JP Morgan's note said there was no light at the end of the tunnel. I presumed you disagreed with that then, and I'm sure you disagree with it now. Good morning to you, sir. How's the outlook for you?
Yes, good morning, Stephen. Good morning, Arabile. Look, there is light at the end of the tunnel. The tunnel sometimes is a bit longer than you would like it to be. But I think we posted today, performance which is resilient in a very challenging environment. So we have improved in Q2 our performance, our comparable sales growth performance versus Q1, but Q2 is pretty much in continuity with Q1. We see the rebound of our OEM and consumer business, while our connected business has been always performing at a good level. But yes, we still are experiencing headwinds in China with enhanced competition, and also in our professional business in Europe. Profit, cash are at expected level, and you will see that our net income has greatly increased due to the fact that we're restructuring, less compared to the previous year. So all in all, yes, a performance which is resilient in a very challenging environment.
Eric, I've had the honour and pleasure of your company for the last 8 years on your journey as well, and probably my most asked question during that whole 8-year period is what about that Chinese competition? What about that Asian competition? You've referred to it there as well. Are you still finding that the vicious price environment is denting those margins?
We had, at the time of the high inflation 2 years ago, we discussed together also, and we only priced up for what we called the structural part of the inflation, which compressed at that point in time our gross margin. Then our gross margin expanded again, and we are now in a phase where the market has been stabilizing towards, a little bit more of negative price. And it's true that in some countries, especially China and India for us at this point in time, we see on the local markets a very, very strong price erosion, which is linked to the fact that people benefited from the increase of price and now price are restabilizing. Now, if you look at it moving forward, I believe that with the price of some commodities which is going up, like metals, for instance, or transportation, I think the tension on price should be less strong than it has been, in the first 2 quarters of the year.
Eric, good morning to you. I mean, when you say restructuring costs, then around 9 million euros then in the second quarter, the hope was still that you'd get some progress to get that 200 million in cost savings. How close to that are you, especially with those 1,000 job losses that you had anticipated too?
Yeah, good morning to you, Arabile. Look, we said that we would get the gross benefit of that restructuring plan, 2/3 in 2024, and we will get it, the 200 million gross in full year 2025. And we are pretty much in line to achieve this. I think when you look at the job losses, and the reinvestment that we did in low-cost countries, we are probably at this point in time 80% done on the program, and we will start to see, the run rate of the full achievement of that plan rather in Q4 this year.
Very interesting. I mean, to get to that as well, you kind of need the sales to be able to ramp up. Is innovation, which is a critical part of your business, not just for cost savings, but also for sustainability. What's delaying that sales progression for you? It's not just innovation, right? Is it just a slower consumer base right now?
But when you look at the market in general, we see a much more positive traction in the US, then in Europe, then in China. And we are not involved only on the consumer business, which is 25% of what we do, but also on the professional business, which is 75% of what we do. What we see coming up is an improved consumer business on the base of a lot of innovation. We have a brand which is called Wiz, which is Wi-Fi and Bluetooth enabled connected lighting. We are bringing to the market the possibility to sync the lamps that you would have in your home with music. So we're continuing to innovate and we're continuing to invest to be able to drive these markets. But at the end of the day, we are facing very different situations, around the world from an economic traction standpoint. Sustainability is still, pretty much at the top of our priorities. We've been publishing in June our net zero transition plan in 2040. And fully 100% validated by science-based target initiatives. And this is for scope 1, 2, and 3, so for our full footprint. So very few companies are doing this. So, we continue to invest because we believe in the long term of what we have put in place and the growth profile of the company whenever, we're going to have a better traction in the end markets.
Eric, I see the pressure on your cash and I see the cash flow positive has diminished a little bit as well. Let me just, again, I talk about our journey and I feel I've been part of your journey. We were both on the Amsterdam Exchange back in 2016. I remember it well when you floated 20 euros and they've never looked back apart from a brief period as well. The problem is you've got a 6.4% dividend yield now as well. Is it possible that actually you could use your cash better than having a 6.4% dividend yield? Or actually, is that really important to your shareholders now, given the fact, and to be brutally honest, your shares have fallen so aggressively from their highs?
Yeah, look, the cash has always been a strong element in our performance. As the company needed, remember when we met, 55% of our business was conventional lighting that we knew would be declined over the years. So the fact that we practiced a constant dividend was part of the equity story to the investors. And I believe we had and I believe we had. Sorry, there was someone talking to me. So, and I believe we had to do so. Now, when I look moving forward, maybe there can be some adjustment on the dividend. Now, the dividend yield depends also on the enterprise value. So, what we need to see the share price increasing, and then the dividend yield will decrease.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.